All right, let's get started. Good morning and welcome to the final Tuesday market outlook for the year. My name is Prakash Vijayanath. I'm a senior analyst here at Options Play. And today I am going to be walking you through how I am viewing the current markets. So before we get started, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by Options Play or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. So our agenda for today, we'll be starting off with the major indices, highlighting those key levels. We have seen a key level broken on the S&P, so we will be analyzing that a bit further. From there, we'll be moving on to fixed income and commodities. We'll take a look at the sector rotational model, highlight which sectors are outperforming and underperforming the overall market. I have a few subsectors of interest for you this morning, and we'll end today's session with some bullish and bearish market movers as usual. So starting off with the Fed rate hike probabilities before we move on to the major equity indices. Last week was a huge week for equities. I would argue probably the biggest week for the year. And that was because there was potentially a lot that could have gone wrong for equities. I highlighted last week that the risk to rewards do favor the downside. However, the recent that inflation number on Tuesday did make me doubt that somewhat because we saw these relative breakouts all across the board for equities. So that definitely did I would be honest, it definitely did confuse me initially because, after seeing these breakouts with inflation being better than coming out a lot lower than expected, what that did is that it confirmed a trend of declining inflation, meaning we are getting inflation under control. And the reason I say that was because the previous month's inflation reading, yes, it came out better than expected, and we saw how much that boosted equities higher. But that was one data metric. It was simply one data metric, and it doesn't justify a trend. Whereas now that we have two inflation reports that have come out better than expected, that does justify a bit of a trend already. And for that reason, my outlook was starting to shift on Tuesday. But then what happened on Wednesday that has seen the severe decline here in equity markets over the last few days was that Jerome Powell basically said that we are going to have higher interest rates and they're going to be there for longer. And we saw equities tumble because of that. Obviously, the optimism surrounding equity, the recent equity rally was due to the fact, or due to this perception that rates weren't going to be this high for that long. There'll be a bit of a pivot earlier on for the Fed before they start cutting rates. So far, that hasn't been proven yet. So that was my main concern about the recent equity rally in the last few weeks was, is there too much optimism surrounding equities? And based on the last 2 days, I think the answer is yes, there was too much optimism. And that is why we have seen this decline in equities. So for the next Fed meeting, that's all the way on Feb 1st, quite a long way away. And we are seeing now a bit of a shift to, I don't want to say dovish, but less hawkish from the Fed. I think the era of 75-point hikes is definitely finished, and we are expecting for now a 25-point hike because the current target rate is 425 to 450, and 25-point hike would take that to 450 to 475. A 50-point hike would take that to 475 to 500. So it's between these two probabilities, and right now the probability of a 25-point hike is at 65%, so a good bit higher than a 50-point hike. But let's see how this plays out in the next few weeks. This is still something we will be keeping an eye on. But moving forward into 2023, I'm actually going to say that the Fed will have less of an impact on equity markets than they have in 2022. Now that we know that interest rates aren't going to be rising by 75 points each every 6 weeks, and there's a decline there, I think investor focus will be shifted more towards EPS trends for companies. So from a macro outlook that we were looking at in 2022, that saw a decline across the board for equities, we're going to shift our focus more towards the micro outlook for 2023, focusing more on how companies are able to actually maneuver themselves in this higher interest rate environment. So a very interesting year ahead, I think. I do think the first 6 months of the year would be a little bit difficult for equities, to be honest with you. I do expect EPS trends to decline across the board. But overall, I do think the fundamentals for individual companies are going to be prioritized more than this macro outlook. And yeah, good question by Miguel, saying that's not dovish. It's priced in at 25 points. You think maintaining the Fed funds rate at 4 to 5% during all year is dovish? It's not dovish. I mean, I'm talking about a less aggressive interest rate hiking policy from the Fed, because we had to work through 75-point hikes for so many months, and now that that's starting to decelerate, obviously we did see that play out in equity markets, which were moving higher. We knew that we were most likely going to be getting only a 50-point hike instead of a 75-point hike, and even though it was still a hike, we saw how positively equities reacted to that. So I'm really speaking on this in relation to equity performance. All right, so taking a look here at the S&P 500, you'd see here price action has been fairly negative across the board. We did see this breakout above 404 all the way to 410, forming a bit of a double top on a lower time frame, but then straight away rejected and actually breaking below the 380 level, which is also the 38.2 fib level on the S&P. So that's a significant break in my opinion. But overall, taking a look at the structure, it's a bearish trend, lower highs, lower lows. So despite the recent equity performance and the recent optimism surrounding equities, it still hasn't broken a bearish structure on the S&P on a higher time frame. Maybe you could argue on a lower time frame, there were a series of higher highs and higher lows, but on a higher time frame, which should be the priority, it hasn't done that. Now, it doesn't necessarily mean we're going to reach a new lower low, but what we could see here is maybe more of a capitulation form. So there's two candlestick patterns that I'll be looking at specifically, either a inverse head and shoulders, which would entail the S&P decline a little bit more, but and form a higher low from the previous low, and from there potentially move a little bit higher or stay more neutral. I don't believe the current environment is suitable for a straight up rebound on equities. The other formation that we could see could be a double bottom here at the 50% fib level. And that would indicate again that the bottom that would confirm the bottom. And from there, we could see neutral to maybe mildly bullish price action. Again, it does depend to an extent on the macro outlook, depending on what happens with inflation, but definitely less of an impact compared to the last few months. I'd be focusing a lot more on EPS trends and whether they can actually recover amidst these higher interest in this higher interest rate environment. Okay, so taking a look here at the NASDAQ 100, looking at the QQQ ETF, similar price action. We priced it initially break out above 290, looking like it was approaching 300, didn't quite get there, and straight away, strong decline all the way to this 268 level. Major area of support, as you can see on the weekly time frame, price has found support on this area on multiple occasions. And the other thing I want to point out is that we can see here shorter term momentum. This is a 6-period CCI, the red line. That is looking like it's at the bottom of the range. So what we might start seeing after this strong impulse move down is potentially some exhaustion, maybe a bit more of a sideways move over the next few days, recovering from not yet oversold, but almost oversold levels for the NASDAQ 100. Overall, though, the NASDAQ 100 a lot more sensitive to interest rate hikes than anything that has to do with interest rates. So this naturally, you're going to be expecting a lot more volatility here. Right, looking at IWM, which is a Russell 2000 ETF, so small caps. Small caps, last we spoke, price was around at 180. We saw them move higher, but immediately it moved lower. Didn't quite reach that 188 level, which is also the 38.2 fib level. Strong area of resistance. And again, price maintaining a bearish structure, forming again a new lower high, and approaching that 50% fib level at around 170. So if this level breaks, I would consider this to actually be a very weak level, the 50% fib level, even though the other fib levels have clearly been a lot more influential. The 50% fib level hasn't really acted as support that much compared to this area here at 164. You can see this is where price did form a double bottom, but unfortunately not enough momentum to see price break above that 188 level. So over the next few days, I do expect price to potentially break below 170 and head towards that 164 area. Taking a look here at bonds. So bonds recovered very quickly in the last few weeks. We saw price was clearly oversold, but maintained this oversold reading for such a long time, for months, and then managed to break back above its exponential moving averages. It did, however, fail to break above this previous swing low. And that again confirms that the bearish structure remains intact, still forming lower highs, lower lows, and set to open a good bit lower this morning at around 103, 104, back at its EMAs. So it'll be interesting to see what price does in this area, whether it can break back below its EMAs or not, because we know that its EMAs have been an area of resistance in the last few months, which could also turn to be support. But looking at momentum, we can see how overbought price was a few days ago. Momentum has since quietened down a bit, but shorter term momentum approaching also that oversold condition at around minus 200. So TLT, I will be looking closely at over the next few days heading into the new year. But for now, the risk to reward does favor the downside because you can see bearish structure is still intact. Momentum, longer term momentum was overbought and it's moving lower because of that. And price action is bearish at a key area of resistance. All right, taking a look at the US dollar. Now, after Wednesday's news or after Wednesday's speech, we saw initially some support for the dollar potentially moving higher. And that didn't really transpire to be the case over the next few days. So what we have here is a break below multiple support levels, including the 105.50 more recently, a failed retest, and a move lower. And even last week's news didn't really push price up by that much. It actually hasn't even reached that 105.50 level to retest that area yet. So the structure remains bearish. Price action, yep, quite bearish. The one thing I will say is momentum is increasing. So even when price is decreasing and momentum is increasing, that can be a sign of positive divergence, and it can also be a sign that a bottoming may occur in the next few sessions or in the next few weeks. But you know, I think fundamentals still are driving dollar price here, and right now there isn't enough bullish price action at a key level to be warranting a more bullish outlook. So if anything, if the dollar continues to move lower, I'll be looking at 102 as a key area of support, as well as obviously 100, which has acted as resistance in the past, minor support in the past, and overall strong psychological level. We do know that the Bank of Japan actually are tightening policy, and we saw a huge surge in demand for the Japanese yen. The dollar is, compared to Japanese yen, it's one of the currencies, one of the currencies in the basket of currencies that the dollar is compared against. So I do expect a little bit of further weakness here. However, from last week's news, I will say that medium to longer term, this actually proves to be more of a neutral to bullish case for the dollar if interest rates stay elevated for longer than expected. Well, there we go. Okay, taking a look here at gold, which does move inversely to the dollar, we're seeing price not have, a very negative reaction, even though it's at an area of resistance that it's failed to break above on multiple occasions, very much struggling at 167, 168. And even though momentum is decelerating here, relative to price increasing, gold is still holding firm at this area of resistance. So not outright bearish, but if I were to trade gold, this is an ideal candidate for a credit spread, a bearish credit spread, where you don't need a strong bearish move to be profitable on the trade. You just need a neutral to moderately bearish move, because right now the thesis for gold is that this area between 167, 168 and around 170, the thesis would be that this area holds as resistance. And with the fact that momentum is declining, does support that thesis. However, remember that if the dollar continues to move lower, that is a bullish case for gold, and that could very easily prove to be an upside catalyst to warrant a break of that resistance level. So if resistance does break, and price breaks to that 171, 172 level, I would expect to see a rally back to 175. We have minor resistance, and we also have a more key level at 177. But for now, gold's price is still being dictated by the US dollar. Okay, taking a look here at US oil, which is the oil ETF. Oil has been on a bit of a roller coaster after this long period of consolidation and chop. We saw a few factors come into play with this price. Very much fundamentally driven right now, oil is, because we had initially a reform of COVID policies in China dictating this price action here a few weeks ago. And we also have US and EU sanctions on Russian oil being imported that's over $60 a barrel. So that is creating a lot of volatility in oil. However, price is respecting this key level of resistance or support at 63. And also momentum at that stage was oversold. So we are seeing a bounce higher in momentum from this oversold condition at 63, which is also a bit of a double top. However, price isn't really breaking above its 21-day exponential moving average. So even though momentum is getting better, it's not enough to see price break above its EMA, its 21-day EMA. And even if it does, the next key level would be 71. So oil is quite difficult to gauge right now. The thesis here for oil is that it stays above 63. And if it does, I'll be looking to play this range between 63 and 71. Okay, taking a look here at sector rotation, we now have 8 sectors in the improving and leading category. We have 3 in the lagging and weakening category. And we are starting to see a bit more rotation, even on the weekly chart, which is what we're seeing. We're seeing a bit more rotation here compared to the last month or so, which saw very limited rotation. So in the leading category, we have energy losing some steam. That has to do with the fact that oil has been declining in recent weeks. But we have materials, industrials, and even staples still, showing some good momentum. Financials and healthcare losing some momentum here as well. However, when it comes to staples and healthcare, given the current environment in the last few days, I think it'll take some time for this to be reflected in this chart because it's a weekly chart. But given the very bearish environment that we've been in, I would still be very much interested in long positions in these defensive sectors and staples, healthcare, and even utilities, because it just provides more of a defense when the overall market is declining. And speaking of defensive sectors, utilities showing a rebound here in relative momentum. Still in the lagging category though, but should this continue, we could see it hit the improving category soon. Discretionary is still quite weak. And also consumer spending trends aren't that great right now. So I think discretionary is actually going to be one of the weakest sectors heading into 2023. I need a bit more data to confirm that, but right now that's where my thoughts are. We have real estate and technology rotating into improving. Both sectors were very much negatively impacted over this year. Pretty much a lot the poorest performing sectors. That's due to their exposure for interest rates, but they are finding some momentum and are in the improving category. I do think this trend could potentially change where they lose that momentum in the next couple of weeks because of the recent price action over the last few days. So I wouldn't view these as bullish candidates just yet. Okay, taking a look at some subsectors of interest. Last week, we spoke about KWEB, which is a Chinese internet ETF. I explained that the reason I like this ETF is that it provides exposure outside of the US and outside of the Fed, basically. And so far, even though this is, a technology sector, and its lack of exposure to the US is clearly showing. Obviously, technology stocks have been hit quite badly the last few days, yet KWEB has not. It's moved a little bit lower, yes, but it's moved a little bit lower from an overbought condition. We can see here that the 50-period CCI was at 200. So this move lower was somewhat expected, but a bit of exhaustion. And even then, very choppy exhaustion. So what I'm looking for here is a continuation lower towards that 27 level. This is an area of support and a previous area of resistance. Was a breakout level as well. And I'll be looking for bullish price action for that ideal risk to reward bullish entry point for revisit back to 32. I mean, Chinese stocks have been hit quite badly, especially their internet sector, but with their reforming of COVID policies and their zero COVID rule, essentially, I do think there is a more bullish case here for Chinese equities over the next few months. Looking at XHB, which is the Homebuilder ETF, another name that we looked at last week, the thesis here was for price to stay above 60. And so far it's holding true, performing very well relative to the overall market, despite this decline in the last few days. For most other sectors and most other stocks, we actually saw this decline break below their relative support levels. But for XHB, we are still seeing price stay above that $60 level. And, this is where I'd probably look for a credit spread opportunity. I'm not outright bullish here on XHB, but my thesis here is for that $60 level to hold, and a credit spread strategy is the best suited to take advantage of that. So look for, potentially another decline today for it to hit that 60 level. And from there, I'd be looking at a bullish credit spread to gain some neutral to bullish exposure here for this name. Taking a look at KRE, which is a regional banking ETF. So we have here price at this 56, 57 level. Bit of a double bottom forming so far and clearly oversold. So my outlook for this sector, quite interesting actually. It is short-term bullish, but very short-term, because I do expect price to retrace a little bit higher from this oversold condition, but I don't expect it to retrace higher than 60. Overall, thesis here is still quite bearish. We could see there's a bit of a topping formation. You could even call that a head and shoulders. And I am looking for that move further down towards 53, which was a previous support level. But for now, over the next few days, I'm looking for a bit of a retracement, and hopefully that would give a much better risk to reward bearish entry point for that move lower. Okay, so taking a look at some market observations, we have General Motors, name that we have looked at for a few weeks. A very patient trade, because a lot of patience was required for this. This was a credit spread opportunity where I was looking for price to stay below 40, and there were multiple occasions, where it did reject 40, coming close to breaking out, but didn't quite find the momentum. But more recently, it managed to break below 37, which was a minor support level. So this now I do think is a good time to potentially get out of the trade. Sure, there might be more downside, but if this was a credit spread, your downside, your max reward is already capped, and you most likely would be very close to that level already. So to protect ourselves from having exposure to a retracement higher before another move lower, I do think now is the time to just get out of this trade. And we know that overall equities are approaching an oversold condition. Maybe not General Motors specifically, but the S&P and the Nasdaq are approaching that short-term oversold condition. It makes sense to actually get out of some bearish positions. We have CLF, Cleveland Cliffs. Again, another bearish opportunity, with the thesis being that it stays below 16. A couple of false breakouts or intraday breakouts, but overall, we are seeing this thesis play out quite nicely. Price breaking below that 21 and 55-day exponential moving average. If you did take this trade before, I think it's okay to leave it on for a few more days. We're seeing longer-term momentum only turn bearish as of yesterday on the daily time frame. I do think there's potentially more downside towards 13 or even 12.50. And Roku. So Roku was another bearish idea that I had for you last week, when price was trading at around 52. Then we did see that initial move higher, but the price didn't quite reach that $60 level, rejected that area, and has moved lower here quite rapidly, back down to 44.50. So again, this would be a take profit opportunity. Price has now approached an oversold condition. It makes no sense to hold on to this trade because it is highly vulnerable to a recovery from an oversold condition and potentially eating away at your profits. So a very quick in, quick out kind of trade. So a new idea that I have for you today is actually Monster. So Monster is part of the staples sector, traditionally a very defensive sector. And if we take a look at its price action on the weekly time frame, we can see that that $100 level was a major area of resistance. And more recently, it did manage to break out of it. So ever since it broke out of this resistance level, it did so with a lot of momentum. So I didn't really want to enter it above where it was a few weeks ago, as it was clearly overbought. But now momentum has declined, and price has also declined very choppily back down to that previous resistance turn support, so far staying above it. And even Friday showing some bullish price action once it did reach that level. So thesis for this trade would be for price to stay above that 99 level, 99.100. And again, good opportunity here for a credit spread. I'm not outright bullish on Monster, but I do expect it to be moderately bullish or even neutral. And taking a look at Intel Corp, Intel has been, it's a very interesting name because obviously this is a name that we're all familiar with. It's essentially a household name due to, its presence in the semiconductor industry. However, it is fundamentally very bearish. And that's because it has been losing a lot of market share to the newcomers like AMD and NVIDIA. And we are seeing that play out in price action. Overall, yes, 2022, no surprise that it's bearish. We saw bearishness across the board for semiconductors. But even if you look at the years previous to that, price action has been fairly neutral or range bound at a time where most stocks, especially technology, were making new all-time highs every other day. And that tells us that the relative performance for Intel over the last couple of years has actually been quite weak. We know that, yes, this is a giant in the semiconductor industry, but it's a giant that's losing market share. So for that reason, fundamentally, it is quite bearish. If we take a look here at the technical side of the picture, still, very bearish price action, huge downward leg from, say, August all the way until mid-October. And then we had a bit of a reprieve, a bit of a retracement higher back to 30. Price didn't really break above that level, back above its 21 and 55-day exponential moving averages and broke below 28. So very bearish price action, momentum turning negative. I do expect this to continue lower, potentially back down to the 24 area or so. And with that, that is all I have for you today. Thank you so much for joining me. And thank you so much for joining me throughout the course of this year. I've really enjoyed doing these market outlooks every Tuesday for you guys. And I'd happily continue that into next year. So looking forward to 2023. But for now, I hope you all have a great festive period, a very happy new year, and I will see you next year. Have a good day, everyone.